For young people, new investors, Sandeep, who are probably earning less than 7 lakh, and now that the government has been very clearly year after year signaling that, look, there is one tax regime where there are no deductions, but we'll give you a higher limit. Invest on your own. And there is another old regime where we still give you some benefits, but you'll have to pay a higher tax. So for somebody, say, who's earning 7 lakh, has just about start or wants to start investing, and does not have the experience of understanding a market or mark to market kind of a product, which is, going to see volatility of its own, of course, much less in debt, but still there. Would you say that that is a category that probably should wet their feet with a good debt fund, which has liquidity, meets their short term goals, which a lot of young people have, right? I want to buy a gadget, I want to buy a bike, I want to buy a car in the first 3, 4 years of my working life. And these are not goals for which you should put your money into equity anyway.
See, it completely depends on the personal, risk appetite. I have seen some large equity fund managers, who invest only in liquid funds. I have known liquid fund managers who invest only in small cap funds. So what you do and where you invest depends completely on your risk profile. And same goes for the investors also. But since you are talking about the younger investors, I would recommend that, maybe put 30% in bank FDs, put 40% in equities, and maybe put 30% in debt funds. So choose just three funds, maybe across AMCs or maybe from the same AMC, and just keep putting money there.
Hmm.
Because bank FD definitely give you certain return even irrespective of interest rate cyclicity, right? Equity should gain because if you are saving for 4 5 years, then uh, the growth story should continue, global growth story and India's growth story. And anyway, you have the huge amount of liquidity surplus in the global system, which is pushing up asset prices. Even if the things go wrong, you will go wrong only on 40% of your investment, and
Hmm.
then probably the debt will do well. So I am saying that divide the money by and large equally across three products. One
Hmm.
where there's a possibility of capital gains hedging your equity markets, and FD giving you straight interest rates. So absolutely, it should be a good combination for them.